And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
It's that time, everybody. Welcome to The Real Investment Show. I'm Jonathan Penn. All my friends, family, clients, they all call me John. As I like to say, my wife Shauna calls me Jonathan. That's when I know I'm in trouble, and that's when I come running. Hey, it's Tuesday morning, so guess what? It's time for it's the Tuesday Two Dads on Money episode, and today it's going to be Two Dads with Tom. So Tom Allen, hey, welcome to the kitchen.
Thank you for having me.
You bet. So Tom here is our retirement specialist. Works a lot with business owners, with tailoring and building retirement plans for them. So we're going to get into some great talking points today with Tom. And Tom is also a dad. Hey,
I am.
Tell me a little bit about your kids.
Yep. So I was joking with John earlier. I'm like, you could tell I'm a dad by the level of white in my beard. So no, I have two young boys, 6 years old and 8 months old. So
right.
I'm still in the early stages of fatherhood, but it's been a lot of fun.
That's awesome.
Yeah.
They grow up fast.
They do. Yeah. 100%.
Enjoy them while they're little. Yeah. So your 8-month-old is like
8 months old.
Turning around, doing the rollovers, all that good stuff.
He's holding himself up. We're starting to get some movement. He's a little bit behind. He's not kind of where I want him to be. I don't think we have a D1 athlete in our future. You know what I mean? It's okay, but he'll figure it out here soon.
No, well, I appreciate you spending some time here in the kitchen. So before Tom and I get into the meat and potatoes of what we want to talk about today, want to take a few minutes just to share some thoughts on the market. I know for every show, I know Lance does his before the bell. That is his wheelhouse by all means. But at the same time, there's been a lot of choppiness to the market so far this year, Tom. And just want to kind of talk about this a little bit because in my mind, this is not a time where I think investors need to be making knee-jerk reactions.
I agree.
And if you look at all of the choppiness that we've had so far this year, and even as we were wrapping up 2025 and getting into 2026, just in our morning meetings that we all have with Lance and Michael and our investment committee, they were pretty outspoken about how maybe 2026 is going to be a year of a little bit more volatility or some choppiness, just by the very fact that 2025, other than how the market reacted after the Liberation Day announcement that the president made, 2025 was relatively smooth, right?
Yes.
So now we're having some more choppiness. Of course, a lot of this choppiness as of late has been around the U.S. conflict with Iran, right? But with all of the whipsawing of the market, look at what the Dow Jones did just yesterday. Like pre-market, the Dow was down about 2%.
Okay.
Right, about 1,000 points, give or take, before the market opened, and I could just feel that there were investors out there wanting to make a knee-jerk reaction where they're like, that's it, I'm done.
Yeah.
This is too much for me to handle. So the market was, pre-market was down. The Dow was down 1,000 points before the market opened yesterday, and then it finished positive. The Dow finished up by 239 points yesterday, right?
That's right.
So a big swing, and a lot of that market strength, of course, came from the reversion that we saw in oil prices yesterday.
Yep.
Right? Big moves in that. So this is, and then President Trump came out and said, hey, maybe this conflict with Iran, this may resolve itself sooner than later, and that oil supplies will be restored. And so we saw the price of oil come down, and I think that provided a little bit of relief, just a relief to stocks a little bit too. But so the market has the market can whipsaw around here a little bit. And so what I just want to tell folks out there in RIA land that are listening to us today, hey, don't make some knee-jerk reactions here, even with all the choppiness so far this year. Through yesterday's close, the Standard & Poor's 500 index is down just over 0.5% for the year. I think it's down 54 basis points, right? So even if you're invested in a 100% index, a Standard & Poor's 500 index, you started the year with $100. As of yesterday, you had $99.46 left in your pocket.
That's not bad. Yeah.
You're okay.
Yeah.
You're okay, right? And if in your portfolio, so far this year, we've seen more of the growth side of the market. Growth-oriented companies are taking more of the pressure so far this year. They've kind of felt the brunt of this choppiness, right? But companies that are more value-oriented, dividend payers, and it's not that dividend-paying stocks are immune to market volatility. They're still equities. They're still stocks. But if we get into some choppier markets, as long as those dividends, that those cash flows that those companies are paying are safe, meaning that there's not a risk that a company like, I'm just going to name one, this is not a recommendation, we do own this in our equity-based portfolio, but a company like Verizon, as an example, as long as we get into some choppier markets, as long as those cash flows are safe, and in other words, there's not a risk that Verizon is going to reduce or cut its dividend, chances are folks out there are probably going to hold on to their shares. And we think other folks that own those shares will probably hold on to Verizon in a choppier market, or just companies that pay more dividends. So in other words, it's not that dividend-paying companies are immune to market volatility, but perhaps they can weather that market volatility a little bit better than maybe what growth-oriented companies can. But you look at some of the sectors or just areas of the market this year that have weathered this choppiness pretty well. Look at sectors like utilities, industrials, consumer staples, materials. All of those sectors through yesterday's close are up in the 9 to 10% range so far this year. They're weathering this market volatility very well. So we've seen some rotation from those growth-oriented companies over to more of those value-oriented companies, companies that pay dividends, companies in the utilities, industrial, staples, materials sectors. Had a client reach out to me yesterday and ask me about bonds. So far this year, bonds are holding their own. Last year, bonds had a pretty good year. Bonds were up close to 6%, a little over 6% last year. Those weren't the equity returns that we saw last year, but bonds held their own last year. And so far, bonds are holding their own this year too, especially longer duration bonds. So if we look at 7 to 10 year treasuries for the year so far, they're up about 1.25%. If you look at an exchange traded fund, TLT, which owns longer duration U.S. treasuries, total returns so far this year through yesterday's close, it's up a little over 3.1%. So while there are areas of the market that are getting more affected by this volatility, primarily the growth side of the market, value-oriented companies, dividend payers, the sectors that I mentioned, staples, industrials, materials, they're doing well. I know there's a lot of folks out there listening in RIA land. They have some exposure to gold, silver, precious metals. So far, they've had a strong year as well. So even with all this choppiness, you're doing okay, right? So I guess what I want to mention before we get into the meat and potatoes of what Tom and I want to talk about this morning is just be careful of the narratives. I see them. I see all the headlines that everybody else does too. All of the big, red, bold print streaming across my screen every day. And I can see how as investors, it's very easy for us to make some knee-jerk reactions to those narratives, right? But what I also want to say is, even though markets are, in general, the market overall this year is somewhat flat or just slightly negative. I'm talking about the Standard & Poor's 500 index. If this choppiness of the market has you concerned, or if you are getting nervous, or if you're losing sleep at night, Lance posted a great article to his blog yesterday where he lays out some thoughts around, if the market should have some pockets of strength here where our investment team everything is subject to change, but if there's some pockets of strength to the market here, our investment team will most likely step in and maybe just raise a little bit of extra cash just to position portfolios to be a little bit more conservative, just in case if this conflict with Iran doesn't resolve itself as quickly as that might occur, right? That doesn't mean we're going to get completely out of the market, right? You don't ever want to be just completely out. But if the market has some strength here, Lance and Michael and Nick on our investment committee, they may use that as an opportunity to raise a little bit of cash and just position the portfolio to be a little bit more conservative, right? Just in case we have some additional volatility. So in the article that Lance posted, and let me get the specific title on that real quick. So go to realinvestmentadvice.com. Stop by our website, realinvestmentadvice.com. Click on the resources tab and go to our blog. And then as Lance and Michael, as our investment team, are researching the markets, the market environment, the economic environment, the political, geopolitical environment, the interest rate environment, as they are forming their research, they craft it into an article and they post it on our blog for everybody to use, whether you're a client of RIA or not. It's a wonderful resource. And yesterday, Lance posted his article is titled "Technical Deterioration, Risk Management is Key," and he goes into he provides a lot of great points around where the market is technically and what are some key levels that he and Michael and Nick are watching for, especially if they decide to step in and raise a little bit of extra cash from the portfolio. So if you're getting concerned, or if this market volatility does have you concerned, this is not a time to have a knee-jerk reaction. This is a time for you to have a plan, right? Use that article as a reference, and if you need help, reach out to us. We're here for you. We're happy to help you through this, right? And I do know that investors are very keyed in on headlines and what's going on with the price of oil and what's going on with all the different moving averages. Tomorrow's CPI data, the consumer price index data, gets released tomorrow. I'm sure all eyes will be on all eyes are going to be on that number, and how does the market react to that? And I'm sure on Thursday, with Michael Leibowitz being our guest, we're going to get into the weeds on that a little bit more, right? So just wanted to provide some thoughts on what's been going on so far this year. But even with all the choppiness that we've had as of late, I think folks expect their portfolios to be down, and in a lot of cases, portfolios are still positive for the year. You're weathering this volatility very, very well, right? So those are just my thoughts about this. I didn't know, Tom, do you have any thoughts around that?
No, I mean, the big themes I picked up from everything was just, number one, here at RIA, we're not asleep at the wheel.
Right.
We're thinking about those contingencies all the time, right? That's the business of what we do. The second thing is if you are losing sleep at night over this, I think that's just a signal that maybe it's time to maybe revisit the financial plan. Because if you have a really good financial plan, it should take into account even severe downturns in the market, right? Those are the simulations that we run to say, hey, even in dire circumstances, how does this whole plan kind of come together, right? So I think if you are losing sleep, that's just a signal of, hey, maybe it's time to call John and have a conversation about hey, I just want to make sure we're clear here, so I know where we're going. And then the second thing is I think investors sometimes have that short-term amnesia of, we've been through periods like this before. I'm not saying conflicts with Iran, but what I'm talking about is, the last few years have been pretty good, all things considered. And I think sometimes we forget some of those severe downturns we've been through before. And, not to say this time is different, seems to be a common theme that comes up during these, I call them the amygdala hijacks. They're just, your brain's just firing and you're seeing the fight or flight. But, it's not something, to your point, to make a knee-jerk reaction over. It's something to say, hey, let's just come back to the table. Let's make sure we're clear. And as long as there's a path forward and we're accommodating this, I think we're good. So
yeah, and I really appreciate how you were talking about focusing on a bigger picture, more of a holistic plan.
Yeah.
Because I too see that investors that have actually put a financial plan in place, and we can model in there, hey, let's take a look at some reasonable forward-looking investment returns. When I say reasonable, we don't know. Will we have historical market returns as our forward-looking returns? Is that what we should use for planning? Probably not. And by design, that's why with the financial plans that we put together, the forward-looking returns that we model are more conservative.
And it's funny, not funny. I'm glad you bring that up because we can talk about theory, we can talk about a modern portfolio theory, we could talk about all those things, but when you're sitting across from a human being and this is their livelihood, I think being on the conservative side is the more prudent and fiduciary thing to do with people's money, because it's real. You know what I mean? Like, you can't just say, well, according to theory, this is what happens. It's like, no, like, this is someone's livelihood. So if we have to tilt one way or another, let's be slightly more conservative with our assumptions or, predictions that we're making or anything like that. Yeah.
Absolutely. And then you have a year like you did last year. Then the message that I have to clients is, go spend. Go take that big trip that you want to take, or hey, you're remodeling your kitchen or whatever it is that you might be doing. If you have some larger one-off expenses that you're planning for, go spend, right? But it's amazing that with how conservative we are for planning purposes when it comes to rates of return, it's not uncommon if we have a year of more volatility in the market, like 2022, great example. When markets were both the stock side and the bond side of portfolios were pulling down in 2022.
Yep.
We can model that, and we can plan for that through the planning scenarios that we run. Like, what happens if markets should pull back? How does that affect the health of your plan? And many of our plans, even when we model in that additional volatility, plans still look great, right? But most of our clients in a year like that, they will tell me, hey John, or hey Tom, you know what? Markets are a little bit volatile this year. I'm probably not going to go take that big trip. I'm just going to wait it out. My plan, I know that my plan supports that I can do this, but I'm still going to kind of wait this out, let this volatility settle a little bit, and then I'll go take that big trip, right? It's just kind of a natural human response.
Sure.
Right?
Yeah, that's your hedge to the volatility. And I would say, you bring up a great point, like in terms of planning. Like I think of planning as like, the markets are the wind behind the sails, but the plan is the compass, right? So like if you're all focused on returns, but it's not going in any clear direction, there's no context about what does all of this mean. Even if the markets are up 14%, sometimes you don't need 14% to get to your goals. And sometimes actually if the market's down 15% and you're only down 2 to 3%, there's a reason for that, right?
Absolutely.
So it's just giving a little bit more context behind those returns.
Absolutely. So talking about planning a little bit. So let's talk about planning for business owners.
Okay.
Because I know this is where you spend a lot of your time. And you are working with business owners and talking with business owners on a daily basis. So I guess a first question that comes to my mind is, as you're visiting with these various business owners, are what common concerns or themes are you hearing from them right now?
Yeah, I think the biggest theme right now is, as markets get more competitive, how do we stay relevant?
Yeah.
That's always on the forefront of a business owner's mind, right? Like, how do we continue to kind of keep growing this thing? But the other big thing is just cost containment of like taking into account inflation, people's expectations around compensation. How do we keep this affordable, right? Because we're kind of getting pinched everywhere. Like, real estate's not cheap, benefits are cheap, inflation's high, the cost of living's high. How do I take care of my people who are the most important asset in my business, right? We can't march forward if I don't have the team behind me to help me build it, right? So those are usually the conversations I'm having most of the time.
So then, I guess when a business owner is looking to put some sort of retirement plan in place or a benefits package in place for their employees, to me that can seem like it can be from the get-go very overwhelming. So how do you break it down? Like how maybe if you could just spend a couple minutes talking about, like, what is your approach? What is your process? How do you start to build this for somebody?
So it walks a very similar path to how you as an advisor would go through a discovery process with private wealth clients, right?
Yeah.
It's kind of like, if we zoom out real quick, I think when most people think about benefits, whether it's healthcare or retirement, they think about it in terms of that typical kind of like agent broker interaction where, hey, if I'm a hammer, everything looks like a nail, right?
Yeah.
Whereas here at RIA, what I've always truly loved about working here is we take a very consultative approach where it's like, hey, it's not I'm a hammer and everything's a nail. It's like we have a toolbox, and there's a lot of cool tools that we can use depending on what the problem is that we're trying to solve. So in a very basic sense, what we're talking about with benefits is how do we incentivize human behavior to get the most productive output out of them in our organization through different forms of compensation, right? Like, we're human beings. We're going to respond to, if you incentivize me a certain way, I'm going to perform at my top level. That's what we're talking about, right? So when it comes to benefits, usually if you're a CEO or you're a business owner, you kind of know what your labor budget is. Hey, of the total amount of money that we make, this amount can be allocated to labor. If you break that compensation down, it comes into a couple of different parts, right? You have cash, you got PTO and sick leave, you got bonuses, you got healthcare, 401k, ancillary, and then it can get really sophisticated with like ride share programs and gym memberships, and like you just keep going down the road, right? It keeps getting more and more sophisticated. But when I sit down with business owners, what I'm trying to understand is just the question of what's going to incentivize your people the most and what matters to them the most.
Yeah.
In some industries, just because of how certain business owners decided to build their business, cash compensation is going to be in a lot more to your employees than like trying to give them this Rolls Royce of healthcare plans, just because that's the economics of that business. Whereas other industries, it's kind of expected. When we talk about like the tech sector, it's like, man, if you're not rolling out the red carpet and saying, hey, here's all the cool things we can offer you, you're not going to be able to hire and retain a lot of the key talent. So for my process is really just kind of understanding the business, what's the problem we're trying to solve, what industry you're in, what matters to your employees, and then building the solution around that. And again, there's a lot of different tools that I can pull from in order to make sure that I'm aligned with incentivizing your people the right way.
Yeah, I mean, and I would think, so how do you go about even starting, putting together a retirement plan for a business owner? What about a business owner who is, they're just getting their business, kind of off the ground, getting it started, but they have a vision, like 5, 10, 15, 20 years from now. They envision their company having this incredible team of employees, but what do they need to start thinking about, I guess, from the get-go to make sure that they can offer that platform and offer those benefits and attract and retain those employees later down the road? Is there anything that you tell folks that they need to start focusing on from day one to kind of get themselves ready for that launch later down the road?
I think it's important to understand the long-term vision because it kind of gives me the North Star that we're kind of working towards. But I break down stages of growth for a business into 3-year segments. So as much as I would say like, hey, John, tell me about your passion. What are you building? Well, the long-term plan is to do this. Okay, cool. Now tell me about the next 3 years. Okay. What does that look like? And then we build the solution in 3-year chunks because different service providers in the marketplace, whether that's your record keepers, your TPAs, even healthcare providers, they corner different parts of the market for different businesses. Like I'll give you just a simple explanation. You got some of like your very basic bare bone 401k plans that are great for startup plans because they're relatively cheap. Could be a great solution. You're going to max that thing out once you hit a certain capacity inside your business. So I like to build solutions around 3-year segments just because it's better at matching service providers to the needs of the business at that stage. But I always give the caveat of, hey, we're going to revisit this in 3 years, and chances are you're going to have a completely different team of service providers supporting your business because your business has grown. You've outgrown these providers. Right? Yeah. So that's how I think about it.
Got it. And so I guess and we can stay high level with this, but as folks are exploring, looking at retirement plans, and I know there's a myriad of different retirement plan, I call them structures.
Yes.
That you can explore, from the very simple to that are more complex. Could you just from a high level maybe just give us some ideas of what maybe some more simple structures to the more complex, maybe kind of what that looks like?
If I was taking a business owner from the beginning to the end, cash compensation is always going to be your biggest lever. So just make sure you get that right first.
Okay.
So that's like Act 1, Scene 1. Act 1, Scene 2 is usually we need to have a conversation around healthcare. Healthcare is the most expensive benefit that employers offer, and you do get economies of scale versus going to the individual markets through like the Affordable Care Act. So it matters the most to your employees to have affordable healthcare because it is so expensive. So after you get cash right, then we start talking about healthcare, and then we can start talking about retirement if that is even in the purview of what's available for your employees. Some industries, retirement unfortunately is just not an important part of the conversation. There's not enough cash left over for them to be able to save. But a lot of industries there is. So if we're just talking very basic retirement structures, I mean, if you're a solopreneur, start with the SEP IRA. Very simple, right? Just start there. Understand that once you start hiring people, that's where benefits start to get complicated. And when I mean hiring people, W-2 employees now can even be part-time and be eligible for some benefits. So like just keep that in mind. But once you hire that first employee, the SEP tends to not be the most efficient way to be building retirement anymore. Then you can get into more simple structures like a simple IRA plan. Then you get into like a 401k plan, 401k with profit sharing, and then you can graduate to kind of the more advanced strategies if you are in a position to where you're really looking to save, 6 figures in compensation.
Got it. Yeah, I guess depending on the business owner, depending on their business income, I know there's some plans out there that can really afford some high contribution limits for them. So you brought up a great point, and I see this a lot too, where a business owner will put together a retirement plan structure they want to put something in place for their employees, so their employees can save and invest for their own futures. But then it's not uncommon where a lot of those employees or plan participants don't contribute.
Yeah.
They don't save. They don't use any of this to their advantage.
Yep.
Right? So is there some sort or type of retirement plan structure where, even if the employees decide not to contribute, or maybe they're not able to, maybe there's just not enough money left over at the end of the month for them, but they should really be paying themselves first. Remember, that goes back to a lot of things that Lance and I discussed in here before. But look, I get it. If times are tough and they're not able to make contributions to those accounts, are there retirement plan structures that still allow the business owner to make contributions?
Yeah, there's ways of structuring it. To answer your question, through like federal legislation like the Secure Act, they're starting to put kind of these behavioral nudges into plan design to saying, hey, there's got to be automatic enrollment and automatic escalation, because to your point, most people aren't going to sign up on their own. They're kind of like, well, what's the incentive to do this? So they're kind of like nudging them along to say, hey, like you need to start saving something, right? So you're not so reliant on, let's just say, government programs when you get into retirement. You're kind of taking care of yourself. That's the incentive. But there are structures in place where business owners can adopt certain provisions that are kind of like your get out of jail free card, where it's like, hey, because I have this provision, I can kind of focus on myself a little bit more, and it whatever my employees decide to do, it doesn't impact what I have to do to take care of myself. Because I mean, you and I talk about this all the time, where you have business owners where a lot of their wealth is tied up in their business, and if you think about it from like a risk management standpoint, that's a lot of risk.
Right.
I mean, what percentage of businesses fail every single year, especially small businesses? I mean, it's outrageous, right? So it's like most small businesses don't make it past 5 years. So if you have a lot of your wealth tied up in your business, then we get to start having the question of like, okay, well, how can we start diversifying your wealth outside of that a little bit? And that's where plan design can be really, really important, because we're just creating structures to make that process as easy as possible for the business owner to say, hey, if I need to max this thing out because I got all of my wealth tied up in this business, and hey, it could go well, it might not go well, so how do we hedge that risk a little bit?
Absolutely.
So that's what we're talking about,
And so let's say, what if, so you mentioned maybe a business is starting off, maybe they start with a SEP IRA or like a simple IRA type of plan.
Yep.
And then, their business is flourishing, it's doing extremely well, and they're growing, and they're bringing on new members, and they're really seeing their employee base and really expand. Is it easy, or is it a straightforward process if somebody has like a SEP IRA plan in place or a simple IRA plan in place to, I don't know if upgrade's the right word, or maybe transition to like a 401k plan from that? Is that a straightforward process?
It is actually. The mechanics of it are relatively straightforward. Where people get into problems is they don't communicate with me that they already have a SEP. They just don't think about it, right? They already have a SEP IRA in place that are already funded. Well, technically, you can't fund 2 retirement plans within the same year. So, like, you gotta make sure you're talking to me about that, so that I'm not messing you up. But for the most part, like, It's relatively straightforward. If you had a SEP and you're like, look, I know I need to graduate to something, we can get something up and running for you within about 2 months. And then it's literally as simple as like, okay, instead of putting money over here, you're going to start putting money over here, and that's it.
Yeah, so you bring up another great point there around timing.
Yeah.
Right? So we're in the beginning of 2026. It's hard to believe that we're going to be wrapping up, Q1 here
Already.
like that,
Yeah.
right? So if folks are wanting to get a retirement plan in place for 2026, is it too late?
No. Yeah, actually, it's not even too, well, we're starting to knock on the door, but
Yeah.
if you filed a corporate tax extension, it's technically not late to get a plan started for 2025.
Is it? Okay.
Yeah, so like as long as you filed the tax extension for the business. So again, with a lot of the federal legislation that's come out over the past few years, they're trying to make it easier for small businesses to set up these mechanisms. Used to be very rigid, but like if you're still considering this as part of your overall financial plan, you still got time.
Okay. And if somebody's maybe wanting to get something in place starting in, let's say, January of next year, January of 2027.
Yep.
Is there an ideal time this year where they should be talking to you?
Yeah, let's start having a conversation in August.
In August.
And the only reason for that is because if we are trying to set up a retirement plan with a safe harbor provision, we just got to make sure we have about a 3-month runway at the end of this year to make sure it's all set up for you in 2027.
Got it.
Yep.
So, and as folks that you visit with that maybe they already have a plan in place, are there some common, I don't want to call them mistakes, or some things that you see that, I guess mistakes or things that maybe are not set up appropriately at the outset, where you should say, hey, everybody, just if you're putting a plan together, hey, just make sure don't do this, right?
Yeah, I would say if you have a plan in place, John, I'm sure there's somewhere in your house, do you have a closet that's just full of stuff and you're just like, I'm afraid to open that thing because...
All of my closets are pristine. Are you kidding me?
Most of the time, I describe going into a 401k that exists as kind of opening up that closet a little bit, like, well, we'll see what falls out, No, most of the common things are the plan provisions may no longer serve you. So it's very common to set up a plan and it's got very basic provisions that are, hey, like that was cool when it was just maybe you and one employee, but as things have kind of evolved, maybe that's not the most efficient structure anymore. Fees are a big problem. Whether they're hidden in the mutual fund expenses, whether they're hidden in the service providers. Some people could be paying to the tune of 2% just for a 401k plan, which is outrageous.
I've seen that.
Not using institutional share class funds. They're using like A shares, and I'm just like, you're overpaying for what you're getting. So most of the time it's around expenses and plan design where I'm kind of like, and sometimes it's even like, hey, like no one's participating in this. When was the last time someone came in here and actually talked to your people about like this benefit you're offering? So
yeah, so when it comes to retirement plans, 401k plans, 403b plans, typically I see there's a menu of different mutual fund options in there that a participant can choose from. And I always like to go in there and take a look at what is their investment, inventory look like that they can choose from. Like what do their choices look like? What are those internal operating expenses? And I'm surprised at a lot of, and maybe there's just not a lot of education around that. So we'll touch base on this here in just a moment.
Sure.
But I seem that my take on this is that a lot of participants in retirement plans out there, they really don't understand what those mutual funds are, how do they work, and they've never really taken the time to look at what those internal operating expenses are.
Yeah.
Like nobody's really taken the time to sit down and really explain this to them.
Right.
Right. So I know you wear a lot of hats when it comes to working with business owners. Creating a plan, getting their retirement plan put in place, helping them monitor and, let's say, upgrade the plan as their business grows.
Yep.
But I know that you also visit with their employees.
Yeah.
And you help educate them. So could you just provide us with kind of an overview of what does that education look like?
Yeah. So within a retirement plan, and you got to remember when when we're talking to people about something like retirement, we can't talk above them, and we can't get too technical, and we can't talk about even like some of the stuff you and I dug into this morning on stock market and stuff. We got to keep it pretty high level, right? The biggest things that are going to make an employee successful in their company retirement plan, their savings rate, pre-tax versus Roth, what makes the most sense for you, and then just picking an investment solution that is more tied to your time horizon and risk preference than anything. Those three things you get right, we're going to be okay.
Yeah.
So what when it comes to the investment lineup, for example, what we're trying to balance is making sure we have enough asset class coverage for proper diversification, but we're not creating so much decision fatigue that when someone looks at it, it looks like the Cheesecake Factory menu where it's like, I got like 50 options to choose from. I don't even know what I'm going to choose, right? So we got to balance out. And what we typically do is like, hey, Lance worked really hard to help me build these pre-built portfolios. There's 6 different risk allocations where it's like, hey, we make this simple for you. We just took your lineup, we put it in a box. That box has different risk levels, and we're just going to choose the one that most ties to what's best for you. So there isn't any decision fatigue. We took a lineup of 25 things and we reduced it down to 6. And really the 6 is like, hey, you're young. We're going to save starting at like 8 to 10%. I want you to do Roth, and it's probably going to be on the riskier side. Whereas if you're a little bit older, we're getting near retirement, hey, either tax diversification between Roth and pre-tax or go only pre-tax, and it's probably going to look more like a brisk walk versus our skydivers out there, right, in terms of risk. So
yeah, that's huge. And are you, so you mentioned both pre-tax and Roth.
Yep.
Are you seeing more business owners being open to, well, of course, now there needs to be some catch-up provisions, I guess, that need to be made on the Roth side, depending on levels of income. But just in general, are you seeing more business owners being open to offering the Roth piece to employees?
Yes.
You are?
Yeah, because there's no disadvantage to them to be able to offer it. It's literally a checkbox in the plan provision documents to say, hey, now most of it is just educating on how the mechanics of that works, but most payroll systems make it super easy. And to be honest with you, it's probably benefiting the vast majority of your employees to have that provision in place.
Yeah.
So,
So, and I like what you said about, the choices or the list of available investment options that are being to use in a plan, because I see that at times where, like a 401k plan, I forget which plan it was I was looking at just recently. I think there were close to 50. Different options in there. And I was going through and helping the plan participant look at developing an investment allocation for them, because they just said I think it was just like paralysis by overanalysis. Like
that's that decision fatigue.
They were just like, I have no idea. And what I see a lot of is like there might be 50 choices in there, and 20 or 25 of the different mutual fund choices in there all own the same stuff.
Yeah.
It's all a bunch of overlap.
We have a bunch of large cap growth funds in here, right? It's like
it's all, but
pictures,
they all own the same thing.
Yeah.
And it's sometimes it's a real challenge for them to properly diversify and build a portfolio in there.
I mean, I work in the industry, and that sounds exhausting to me.
Yeah.
You know what I mean? So 50? No, I tapped out. Yeah.
Yeah. No, so I'm with you. So any other common questions that you get from just plan participants as you're visiting with them and helping them with just the educational piece?
It's probably what the business owner doesn't want to hear, but hey, if I end up leaving this job, very common in nowadays, right? Like if I have 5 different jobs, 5 different careers, what happens to this money? It's not the pension plans that our parents grew up in, where it's like, hey, 30 years, it stays in one place, you get the golden watch. That doesn't exist anymore. So it's like if you ever leave your employer, there's ways to get access to your money that's not stuck with the employer.
Right.
So the portability is just making sure they're educated on that as well.
So there's a very diverse group of business owners out there, right? Is there a certain business owner or segment of that market that you find yourself working with more? Like, kind of, is there somewhat of a sweet spot?
Yeah, great question.
More than not.
Yeah. Once companies start to get a little bit bigger, you understand that there are certain employees that are absolute keys to the success of the business, whether you're looking to exit at a good multiple. So you need to have those employees around for a while to make sure that actually happens. or you're just kind of building that ascension structure of like, hey, I don't want to be the CEO owner forever. I got to kind of bring up the next generation of people. So once your organization starts to get larger and you have those different levels of managerial, let's just call it firepower, there's ways to structure 401k plans to target those key individuals to make sure like, hey, like these aren't just basic rank and file, these are key people, and we can build compensation packages that are tax deductible benefits that incentivize that person to stay there. And that's where things get really, really fun for the business owner to say, hey, I thought I only had cash as my only lever to keep this person around. I'm like, no, like you have a few different levers if you want to hold on to that person as you grow this business or organization.
Yeah, very helpful.
Yeah.
So, and if, hey, maybe some of you out there listening today, maybe you've been wanting to put together a retirement plan or just have a conversation around it, right? Tom's here, he can help you with this. So feel free, if with any question that you have out there, stop by our website, realinvestmentadvice.com. Reach out to us. We're here to help you. We're all fiduciaries, right? We really want to help you, set yourself up for longer term success. Before we wrap up, Tom,
sure.
Any closing thoughts or any final thoughts that you have for folks that are out there listening today?
Yeah.
That you might just, any closing thoughts around, hey, if you're thinking about putting a plan together, think about this?
I would say the big thing I want people to consider is, again, kind of go back and look at this, how we started this conversation of like, you have an allocation earmarked for labor, right? Cash compensation benefits. And I think looking at it holistically from a 30,000 foot view allows you to understand where you can move different parts of that package. For example, natural inflation rate for healthcare services in the United States is 12%.
Yeah,
12%.
12%.
So just if the only thing that happened in your business is everyone got 1 year older, but no one went to the hospital, premiums are up 12%.
Yeah.
That's just the reality we live in. So the pressure that most business owners are feeling are, well, that's unsustainable. How can I keep up with that? My business can't even grow by 12% per year at a more mature stage. Like, how do we make this happen? Just understand that there are other ways to where you can kind of, if you're looking for ways to save money to be able to afford the bigger priorities you have in your benefits package, there are ways of doing that specifically within the retirement plan space to where you don't need to be paying for the Rolls Royce in retirement anymore. A lot of that's getting more automated. A lot of the fees are coming down within the 401k. So if that resonates with you as a business owner, there's an opportunity for us to not only look at the healthcare side to make sure you're not just paying for the most expensive thing. You and I talked about this before we went on air, the BUCAs. The fully insured carriers, like they're very expensive, and that market is evolving to where there are more affordable options if you have a relatively healthier risk pool of people that work for the company. So there's ways to save money there, and then if we need to save more money, there are a lot of different 401k providers that are coming out that are putting a lot of fee compression on the industry, which is great. It's just allowing business owners to win.
Yeah. So you threw out that acronym BUCAs.
BUCA.
BUCA.
Yeah.
BUCA. So, and I know I asked you before we went on the air, and I was like, Tom, what is a BUCA? What is this? So
the BUCAs.
Can you just elaborate on that real quick?
Yeah, BUCA. BUCA. Blue Cross Blue Shield, United Health, Cigna, Aetna, four major health insurance carriers in the industry. We call them the BUCAs because they're the big boys, but if you have a fully insured healthcare plan, it's usually through one of those four.
Got it.
The question, but like most people, unless you work for a larger company, most people just think that those are the only options that are available, and that's not true. Because with the BUCAs, what you're doing is they're putting you amongst a larger pool of people within your region. Some of those people could be high risk, could be driving the cost of healthcare and premiums up.
Yeah.
So if you are in a unique situation where like your firm is relatively healthy, you don't need to subsidize the sick people in the BUCAs anymore. Like you can go find a different solution that's actually probably going to cut your cost by close to 40%.
40%. Wow. Okay. So
there's trade-offs there, but I'm just saying, like if that resonates with you, like, oh yeah, that does make sense. Like there might be better options out there.
Yeah.
So, yeah.
That's great. Thanks for elaborating on
sure,
that too, because I was like, BUCA, what is that? What is that? I just learned a new term today. See.
Yeah.
So I always enjoy learning something new, and just today, just with this conversation, I learned so much. So thank you.
Yeah.
Hopefully everybody out there, this was a conversation where you took something from this. If you're a business owner, in where you're looking to start a business, if you have a retirement plan for your business in place, or you're thinking about starting one and you don't even know where to start or who to turn to, reach out to Tom. Hey, so he would be happy to help you with this and happy to talk about this with you. So again, really appreciate all the time that you spent with us today here on Two Dads on Money, Two Dads with Tom. Stop by our website, realinvestmentadvice.com. Go to our blog. Look at the article that Lance just loaded up yesterday. Wonderful piece of information. And then, hey, come back with us tomorrow. Joining me here tomorrow is another one of our advisors. I think I need more coffee. Devota is going to be here with us tomorrow morning. We're going to be taking live Q&A. Plus, Devota and I might also talk about working with your advisor. It's a lot more than just stocks and bonds. We may touch on that a little bit too. So thank you again for spending some time with us today. Tom, thanks for joining me in the kitchen. We'll see you back here tomorrow.